In my last video, I specifically told you that silver's paper price could crash lower based on pure technical structure. Price was trading between $82 and $83, and I explained that the 150 exponential moving average on the hourly chart was acting as resistance, not support, which meant the structure was vulnerable to downside. Then history happened. On January 30th, 2026, silver experienced a catastrophic 35% collapse in a single day, plunging from around $110 all the way down to $75. This was the worst single-day crash since the Hunt brothers tried to corner the silver market back in 1980. But here's what's developing right now as I'm recording this on February 13th, 2026. Silver has rocketed back to 80.02's $49. That's a powerful 10% recovery from the lows in just under 2 weeks. The critical question facing every trader and investor in this market is whether we've confirmed a bottom or whether this bounce is a dangerous bull trap designed to suck in late buyers before another devastating leg lower. OG John AG here, and before we dive deep into the verified data and market structure, let me be absolutely crystal clear about something that never changes. I will never ask for your money. Never. No courses, no signals, no mentorships, no paid groups, no exclusive communities, nothing. If you see someone anywhere on the internet using my name or claiming to represent this channel trying to sell you anything at all, it's a scam. Report it immediately and protect yourself. I'm here to provide real information from verified sources, not to create panic or sell you false hope or manipulate you into buying something. This is financial warfare education, not financial advice. I'm not building a sales funnel or trying to monetize your fear. I'm building a legacy by teaching you how to read market structure yourself, how to verify data independently, and how to think critically so you're never dependent on anyone, including me, for your financial decisions. Now, if you're actually learning something valuable from this channel, if you're taking the time to verify the data I share, and it's genuinely sharpening your understanding of how these markets really operate, comment John OG below. Just those 2 words. It tells me who's paying real attention and who's serious about understanding what's actually happening beneath the surface. And if you find value in this verified information and transparent analysis, hit that subscribe button because this channel exists to empower you with knowledge and teach you independent thinking, not to sell you dreams or create dependency. Current market prices. As I'm recording this on February 13th, 2026, silver Western spot price is trading at $82.49 per troy ounce. Silver futures contracts are hovering around $83. Before the Chinese New Year closure that just began, Shanghai Gold Exchange was showing elevated premiums that reveal everything you need to know about the massive disconnect developing between physical metal and paper contracts. Gold Western spot is currently trading at $4,160 per ounce. I want you to check real-time exchange data yourself on any major financial platform. Every single number I'm giving you is public information that's verifiable and updated continuously throughout global trading hours. Don't just take my word for any of this. Go verify it independently because that's how you build genuine understanding instead of blind faith in someone else's analysis. Now, let's break down exactly what just happened in these markets and what it means for price action going forward. On January 30th, 2026, silver didn't just drop or correct. It absolutely collapsed. A 35% crash in one single trading session. Silver went from trading around $110 per ounce all the way down to $75 in a matter of hours. This wasn't some organic sell-off triggered by weak economic data or deteriorating fundamentals. This was a coordinated deleveraging event engineered through margin requirement increases that forced massive liquidations across the futures market. The CME Group, which operates the COMEX exchange, where silver futures trade, raised margin requirements on silver from 11% to 15%. They simultaneously raised gold margin requirements from 6% to 8%. When margin requirements get hiked that aggressively, leveraged traders and speculators face an immediate binary choice. Either inject massive amounts of fresh capital into your trading accounts right now, the second to meet the new higher requirements, or close out your positions immediately, regardless of price. The vast majority of leveraged speculators simply couldn't meet those margin calls on such short notice. The inevitable result was a liquidation cascade that wiped out weak hands, triggered every single stop-loss order sitting on the books on the way down, and created a self-reinforcing downward spiral where selling pressure created more selling pressure in a vicious feedback loop. What makes this situation particularly fascinating from a market structure perspective is that 2 legendary Wall Street analysts had actually predicted this crash before it happened. Marko Kolanovic, the former chief strategist at JP Morgan Chase with a career spanning over 20 years, who was inducted into the prestigious Institutional Investor Hall of Fame, had publicly warned that silver could fall 50% from its recent highs. He identified what he called speculative mania in the price charts, and argued that the parabolic rally was being driven primarily by momentum traders and retail speculation rather than genuine fundamental supply and demand dynamics. Peter Brandt, a futures trading legend with literally decades of experience reading price action across every market, also explicitly called out the parabolic blow-off top formation and warned that a severe technical correction was mathematically inevitable. Both of these world-class analysts were proven completely right when the crash unfolded exactly as they had warned it would. But here's what most people in the market completely missed, and what's actually far more significant than the fact that they accurately predicted the crash. Immediately after the sell-off played out and hit that $75 low, both Kalanovich and Brandt flipped their market stance from bearish to tactically bullish. They immediately started calling for a bounce and a potential recovery phase. That shift tells you something absolutely critical about how professional institutional traders operate versus how retail traders get emotionally trapped. These aren't perma-bulls who are blindly bullish all the time or perma-bears who are perpetually negative regardless of conditions. They're reading the tape in real time, constantly adjusting their analysis to what current market structure is actually telling them, and positioning their capital accordingly based on probabilities, not emotions. The fact that they accurately predicted the crash and then immediately repositioned for a tactical bounce demonstrates that this was extreme volatility occurring within a larger ongoing structural trend, not the final collapse and end of the entire silver bull market. Silver has now recovered from that $75 capitulation low back up to $82 as I'm recording this, which represents approximately a 10% bounce off the absolute bottom. The critical question that matters for every trader and investor navigating this market right now is whether that $74 to $75 zone marked the actual bottom of this entire correction phase, or whether this current recovery is merely a temporary relief rally. A classic bull trap that's designed to suck in optimistic late buyers before the market rolls over for another devastating leg down toward even lower prices. Let me show you exactly what the verified data is actually telling us and which specific price levels genuinely matter as we move forward. First and most importantly, we absolutely must discuss Shanghai physical premiums, because this is the smoking gun evidence that mainstream financial media is completely ignoring or deliberately refusing to report on. Immediately after the crash on January 30th, when Western paper markets were showing silver trading at $75, the actual physical silver price on the Shanghai Gold Exchange was simultaneously trading at an absolutely massive 29% premium over COMEX paper prices. That translates to a real premium of $22.98 per ounce. Let that sink in for a moment. Paper silver contracts in New York are getting absolutely crushed down to $75, while physical buyers in Shanghai who want actual metal delivered to them are simultaneously willing to pay $97 to $98 for exactly the same commodity. But the divergence gets even more extreme when you properly factor in the actual mechanics and costs of physically moving silver out of China. To legally remove silver from Shanghai vaults and warehouses, you're required to pay a 13% VAT tax imposed by Chinese authorities. When you properly include that mandatory tax in your calculations, the effective premium explodes up to 45.8% or $36.22 over Western paper prices. The cost of shipping and insuring bulk quantities of silver via air freight from London or New York to Shanghai runs approximately $2 per troy ounce. That means there was a pure arbitrage opportunity worth over $34 per ounce, available for anyone capable of shipping physical silver from Western vaults to Eastern physical buyers. When you observe price spreads getting that extraordinarily wide between different markets for the same physical commodity, metal flows. Physical silver gets systematically pulled out of COMEX and LBMA warehouses and gets shipped to wherever the genuine real demand actually exists. As of today, February 13th, even after the substantial recovery in Western paper prices, back up to $82, Shanghai is still trading at a measurable premium over COMEX. Depending on which specific contract you're examining and what exact time of day you're checking the data, current premiums are running anywhere from 4% all the way up to 10% over COMEX paper prices. That persistent ongoing divergence between physical metal prices and paper contract prices is the single most important signal in this entire market structure right now. When real physical buyers who are demanding actual deliverable metal in Eastern markets are consistently willing to pay premiums of 4 to 10%, while paper traders in Western futures markets remain nervous and continue selling synthetic exposure. The paper pricing mechanism is actively fracturing in real time before our eyes. This is what serious market analysts are calling the great divorce between physical silver and paper silver. The two related but distinct markets are progressively detaching and decoupling from each other. Paper contracts can be manipulated downward through excessive leverage, coordinated margin hikes, and algorithmic selling pressure. Physical metal flows inexorably toward whoever is willing and able to pay the highest actual price. And right now, That's clearly Eastern physical buyers, not Western paper speculators. Now, let's examine ComEx's registered inventory data, because this is precisely where delivery pressure is building toward potentially explosive levels that could force a market structure change. As of February 12th, 2026, ComEx's registered silver inventory sits at approximately 103 million troy ounces. The total inventory, when you include both registered and eligible categories combined, is around 381 million ounces. But here's the absolutely critical distinction that most market participants fundamentally misunderstand. Registered inventory represents the only metal that's actually available for immediate delivery against maturing futures contracts. Eligible inventory is simply silver that happens to be sitting in ComEx-approved warehouse facilities. It meets all the technical quality standards and it could theoretically be converted to registered status, but it's not actually available for delivery unless and until the legal owner of that specific metal makes an active decision to issue an official warehouse receipt and explicitly make it available. So the only number that genuinely matters when we're analyzing real delivery pressure is that 103 million ounces of registered inventory, not the much larger total inventory number that includes metal that isn't available. Now, compare that 103 million ounces of registered deliverable supply to the March 2026 futures contract. Open interest, which is currently sitting at roughly 4 to 429 million ounces, depending on which data source you're using and precisely when you check it during the trading day. Let's use the more conservative estimate of 400 million ounces to be completely fair in our analysis. That gives us a ratio of nearly 4:1. There are 4 ounces of paper claims in the form of futures contracts outstanding for every single ounce of registered physical silver that's actually available for potential delivery. If even just 25% of March contract holders decide to stand for delivery and demand physical metal instead of either rolling their contracts forward to later months or accepting cash settlement, that action would require 100 million ounces of silver to be physically delivered against only 103 million ounces currently available in registered status. We're talking about essentially the entire registered inventory being demanded by just 1/4 of total contract holders. If the delivery rate approaches anything close to what we witnessed during January and February 2026, where actual delivery rates range between 50 and 98% depending on the specific contract month, ComEx could potentially face an absolutely historic stress test on February 27th, when March 1st notice day officially arrives. That's the critical date when traders holding long March contracts can formally notify the exchange of their explicit intention to stand for delivery and take actual physical possession of metal. February 2026 saw delivery demand hit approximately 98% of open interest. Out of 19.11 million ounces of total open interest at the beginning of the month, an astonishing 18.72 million ounces were actually called for physical delivery. Think carefully about what that statistic actually means for market structure. That's not a futures market functioning the way futures markets are theoretically designed to function, where the vast majority of contracts routinely get rolled forward to avoid the expense and logistical complexity of arranging physical delivery that's functioning as a physical allocation and distribution mechanism. Market participants aren't trading paper contracts to speculate on future price movements. They're explicitly demanding the actual metal bars. January 2026, physical deliveries hit 49.4 million ounces, which was precisely 7.27 times higher than the delivery level witnessed in January 2024, just 2 years earlier. The trend is absolutely unmistakable, and it's clearly accelerating month after month. Delivery pressure is intensifying systematically. ComEx registered inventory has been draining at a calculated rate of approximately 785,000 ounces per day over recent weeks, based on official warehouse reports. If that measured drainage rate simply continues at the current pace through February 27th, when March 1st notice day hits, there may only be around 85 million ounces of registered silver remaining available by that absolutely critical date. This precise setup is what has serious professional analysts openly discussing the realistic potential for a ComEx default scenario or force majeure declaration during March. Now, let me be extremely clear about this because I absolutely don't want to create panic or make definitive predictions. I cannot fully back up with certainty. I'm not predicting that ComEx will definitely default during March 2026. Markets have multiple different mechanisms available for resolving these kinds of structural imbalances before they reach an actual breaking point. Prices can spike dramatically higher, which naturally incentivizes more metal holders to voluntarily convert their eligible inventory into registered status and make it available for delivery to capture higher prices. Contracts can roll forward en masse to later delivery months like May or July, temporarily pushing the delivery pressure further down the calendar. Cash settlements can occur where instead of delivering physical metal, the exchange settles maturing contracts in dollars at current market prices. Emergency regulatory measures can be rapidly implemented. But what you're witnessing right now in real time is completely undeniable structural tightness in the physical silver market that paper price manipulation can only artificially suppress for a finite period before something fundamental in the market structure has to give. Either prices have to rise substantially to accurately reflect genuine physical scarcity, or the paper futures market progressively loses credibility as a legitimate price discovery mechanism for the underlying physical commodity. Bottom line for your decision making. In my previous video, I explicitly said we could go lower on paper price because the 150 EMA was technically acting as resistance, not support. You can go watch it yourself. Timestamp starts at 2 minutes 20 seconds onward. The crash happened exactly as the technical structure indicated it could. $3.6 trillion in global market cap wiped out in 90 minutes, right before major CPI economic data release, and right before the Chinese New Year closure window. Silver crashed from 110 down to 75. Now we've bounced back to 82. If that $74 to $75 zone holds firm as support going forward, we have legitimate potential for an inverse head and shoulders pattern to develop, which would represent a classically bullish reversal setup. If 74 breaks decisively to the downside, we could retest previous lows near $64. Shanghai physical premium remains elevated between 4 and 10% depending on contract and timing. Physical metal is actively separating from paper contracts. Banks are attacking right on schedule using SLV arbitrage mechanics, coordinated margin hikes, and sophisticated algorithmic spoofing. The volatility is absolutely not going away. Silver remains capable of moving 8 to 10% in either direction within a single trading session. March potentially faces a delivery squeeze according to legendary analyst James Turk's specific warning based on the delivery mechanics and pressure that's visibly building. Conch's registered inventory sits below 103 million ounces, while March contract claims exceed 400 million ounces. First notice day hits February 27th, which is just 14 days away as I'm recording this. Watch that $74 support level closely. Watch how price reacts around the 150 EMA on shorter time frames. Watch for any official news from COMEX regarding delivery intentions as we approach first notice day. Watch Shanghai when it reopens February 23rd to see if premiums remain elevated or collapse. And most critically, verify everything I'm telling you through independent research. Don't trust my analysis. Trust that you can verify the specific levels I identified actually played out exactly as described using publicly available timestamps and verified price data. Go check SLV premium discount data yourself on financial websites. Examine COMEX registered inventory official reports published daily by CME Group. Pull Shanghai premium data from metal charts or other verified sources. Review Silver Institute reports on structural supply deficits. Access COMEX delivery data directly. It's all completely public, independently verifiable, and continuously updated. The ones who actually do that homework understand this isn't prediction or fortune-telling. This is systematic tape reading. This is understanding documented market structure. This is recognizing repeating patterns, because the institutional playbook doesn't fundamentally change over time. The real warning isn't about whether I'm right or wrong on any specific call. The warning is, learn to read and verify this data yourself, so you're never dependent on anyone including me. Protect your capital above everything. Verify all claims. Understand that silver at current levels remains capable of extreme violent moves in both directions. If you found real value in this breakdown, comment John OG below and subscribe to this channel. Stay sharp.